Wow. One of our biggest asset classes in this country, Australian super. And boy, if you don't understand it, you better learn. We're going to tell you a little bit today. Stay tuned.
I'm the ringleader, so listen up.
Good morning, everyone. Welcome to Morning Minutes. Myself, Michael Burgio Mark Novak, episode 1491, talking about Australian super. It's up to $4.2 trillion as an asset class, well past the Australian Stock Exchange. What next? Who would have known this policy that was introduced in the early 1990s would become so big? It's gone. Who would have known, Mark? Who would have known?
Who would have known? Well, like you see that television commercial where there's that big purple monster walking down the street. It is a monster. Australian super. It is just incredible. It's the second biggest super per capita in the world to 180 countries. So we have put in a shit ton of cash into super. People don't know what to do with it. They are aware that it's there. But Michael, just to put this into perspective for people out there, so 4.2 trillion out there in super. Australian property market is valued at 11 trillion. The Australian Stock Exchange, when you add up all of the companies in Australia, 3.5 trillion. Debt levels for household debt, 2.4 trillion, proportionally
That's
to the 11.
that's one of the biggest factors, and I think that shows a very healthy economy and property market. And whenever people ever since I've done real estate, there's always those doomsdayers who believe the property market's going to fall by 50%. And
Yeah,
the reality is, once I heard that figure maybe 8 years ago, it was like 9 trillion it was very similar ratios.
for
And once I
property.
heard that, it gave me so much confidence in the property market, because even if the value is halved, it's still a healthy economy. But knowing that majority of households have very little debt on it means they don't have the financial pressures from banks and interest rates to panic sell. So, or if it goes down 5%, they're cutting their losses and they're selling. It just doesn't have that setup. Now, don't get me wrong, I would love to see the figure on the last 5 years of debt to value ratio on any new purchases, but historically, a lot of baby boomers, a lot of households owned that have gone up from 200 grand to 3 million. So that's a big factor in that. But overall, very healthy. And I think that's when you're seeing more and more money is going into super funds. Like, I think it started 3% of your salary. Now it's up to 12%. For
Back in
savings.
1992.
Yeah. And makes sense. Like, people are living longer. If you think when people were planning for retirement, what was it? You worked till 65 and life expectancy was 70. They're thinking 5 years of funding. Now, retirement 65 and you're living till you're 80, 90. There's nearly more life after retirement than during work. So I think something smartly needs to be done with that money, because I don't think you can just wing it and rely on everyone to put money away. So it's pretty smart, and it's good that it's growing.
Super's got so much money they don't know what to do with it. The super in Australia is bigger than the Australian stock market. Even if they could own the stock market 1.5 times over, domestically. So they're forced to make investments offshore. They're forced to make investments outside of the ASX, which is really interesting. What's actually scary is that actually there's the law of compounding. So you know if you think to yourself, that's been 3% or 5% or 9% compounding over the years, Now that's going up to 12% with your super.
Mm.
That's a shit ton of people's money going into super. And that compounding, if you think it's grown aggressively over the last 35, 40 years, because it started in
Yeah.
1992, you wait until people are pinging it at 12%. It's going to go, it's a lot of money. Now, what's interesting is people, it's robbed people from today's money to make it tomorrow's money. So what's actually happened is in the 70s and 80s, mum and dad investors, and we have them, we rent out properties for them now. They didn't have super, they bought an investment property and they still own it 30, 40, 50 years later. So
Mm.
that when there was mandatory super having to be paid, they say it was from the employer, they say it's for the employee, and people go, "Oh, you wouldn't have seen that anyway." But make no mistake, it was calculated into a person's wage. So people were getting paid less in the last 35 years due to super. And there was just this there. So they're not buying the investment property. And it's just there's a whole bunch of people that are left without investment properties today that are now making moves. So we're seeing some big changes with when we meet super people. Super's our biggest customer at Novak Properties.
Like,
One,
and you
one singular customer, yeah.
and it's interesting. Like when super first came out, you would only sell like the 200 grand storage unit, the 200 grand office. Now you're
Yeah.
seeing $1 million purchases under super, and I think that shows the growth in super. And obviously, there's caps on how much you can put in it, so it does take time. But I think you're right. From a zero start to get to 4 trillion, now you see compounding from 4 trillion. The next 5 to 10 years, it's going to be bananas.
At a higher percentage.
Yeah. But you are right with the part where employees getting paid less. So let's say they're on 100 grand, 10, 12% super, let's just say 10% less. They could have saved themselves 5 years for a deposit on a property if they had that, but they don't have that. So therefore the government puts it away. It's interesting. I can see pros for both, but I suppose we're in such a society that wants to be spoon-fed. It's probably the best decision.
Yeah, look, I think forced savings great. I think the intention is pretty awesome. If you look at why super was introduced yeah, so the government doesn't have to look after you as much when you're retired effectively. You've got a nest egg there. So the more a country can have in their citizens' super, the less their citizens are going to be dependent on the government when they become aged. So our aged population having this $4.2 trillion there. And guys, this is a live show. We're talking about super. Feel free to ask any questions if you like. But, it's a good thing. But because people haven't, it's only suddenly got to a critical mass with people where they can do something with it, i.e., buy a property, i.e., invest it differently. And people haven't formally been trained. The investment property in the 70s and 80s and 60s and 50s, you just did what mum and dad did or friends and family did, and you sort of had this formal training on what to do with my super. What to do with an investment property. But now there's been no formal training on what to do with my super. So we're starting to see people see this nest egg that they've got. As a couple, they may have 200K each, and they're 35 years of age, 40 years of age, and they're like, "That's 400 grand we've got sitting where, and what can we do with it?" I get worried because you get unsavory people saying you should do this, you should do that. But a good old fashioned organic investment with your super, like buying a 2-bedroom unit in DY, it's a pretty solid investment.
Yeah. And I think you're right. The money that's sitting there, and especially if you can buy something early, like you could have 20, 30 years of forced growth. So I think it's pretty powerful.
Look, the beautiful thing about property is that if you put in 100,000, you go to the bank, you borrow 4, and you've got 500,000 compounding in capital growth, which will double. So your 100,000 is not doubling, your 500,000 is doubling. Again, beautiful because it's compounding. And then furthermore, you're not enjoying the rent from 100,000, you're enjoying the rent from 500,000. So back to what you said, Michael, if people realize that now, that yes, super can purchase houses and units as investments, and then you're compounding at a greater figure, different to the stock market, you put 100,000 in the stock market, you've got 100,000 of capital growth, and you've got 100,000 of enjoying the yield per year, as opposed to 500,000 if you're investing it in property because you're compounding it.
And I think
So
I like
huge.
the super part as well is you can't take as much debt on the property, so it's got a better ratio of equity to the value, because you're like, when you're leveraging 95, 100% paying interest on it, it can sort of weed out a lot of that growth. But super, I think it's still, what can you get, 2 to 1, isn't it? If you've got if you've got 200k in super, you normally can get 400k or 500k.
5 to 1 or 4 to 1, depending on the
Yeah.
asset class. So
Amazing.
with residential, they'll do 20% loan, and with commercial, they'll do a 30% loan. In general, that may change,
Yeah.
but that's big coin. But people aren't formally trained on it.
We're not
Again, this
formally
is not
trained on
this
any
is
finances.
no.
You leave school.
Yeah,
And
that's right.
we learned nothing about the real world, and now you add super to it. It's a whole nother. Doing super is like doing your PhD or your master's in real life.
And this is not financial advice, by the way, guys. This is just an observation of what we're seeing in the marketplace with our buyers. So when I say these ratios, it's what I'm
Very
hearing.
smart buyers.
Do you know what I mean? So it just but more on our observations. We storage units 200k, bang, but we're seeing people buy that with super. Units in DY, bang, we're seeing people buy that in super. Commercial properties, warehouses, bang, $100 million, we're seeing people buy that in their super.
The most
And
savvy people I see buying in their super is they've got their own business and they buy property for their business. And there is fluctuation in commercial rents. So where they take the most of it is feeding money into their super. So I got this client, he's got an office, and this property, let's say went to the market today, would lease for 100 grand a year. But if you told me there was a lease on it for 170 grand a year, I would say that's high, but it wouldn't be unreasonable. It could have leased a few years ago in a really good market. It could be a 10-year-old tenant and the rent's compounding. But that's an extra $70,000 a year forcing into the super, where you can't do that anywhere else.
that's right. Was that a train that I just heard, Michael?
Yeah, that means an alarm. My email.
There's a train station outside where you are?
Yeah. And it just lets me know a letter has been sent via the web. A letter
so guys and girls,
that's next level.
I'm inspired. I think as an economy that is really strong, 4.2 trillion in the Australian super with such a small population, bigger than our whole stock market, almost half of our property market in cash, in super, right there. I think well done to Australians. It's been 35, 37 years of contributing to super. Feel good about your economy because, those ratios could look very different. Debt, household debt sitting at 4.4 trillion. ASX is sitting at 3.5 trillion. They're four massive asset, or probably the four biggest asset class. They are the four biggest asset classes in Australia, and the numbers sound good. So well done to Australian super, and go out and buy a property in your super. You can combine it. Apparently, we see people combine it with their kids or with their wives or with their friends. Two business partners could buy something. Tradies, electricians, people are getting smart with it now.
Yeah. Beautiful. Super.
Thank you very much. See you, Mr. Burgio.
Yeah, Mark. Thank you.
Have a great day, everyone. Bye.